Good afternoon and welcome to today's Fiera Real Estate Investor Webinar. Thank you for attending. My name is Minty Brown and I'm part of the marketing team here at Fiera Real Estate. Before I introduce today's speakers, I'd like to just go through some general housekeeping regarding the webinar software and how to use it. Firstly, today's webinar is being recorded and your line will be on mute throughout. A replay will be available 24 hours after the call using the same link you were provided for this call. The webinar console you are looking at now can be completely customized. You can minimize and move any of the windows you have open, and you can submit your questions at any time via the question and answer tab, which is located at the bottom of your screen. As a brief introduction for those of you who are less familiar with us, we are the UK division of Fiera Real Estate, an investment management firm with offices in Canada and the UK that globally manages over $4.4 billion of commercial real estate through a range of investment funds and accounts. We are the real estate arm of Fiera Capital, a leading global asset management firm with $111 billion of assets under management. Here in the UK, we operate a vertically integrated business model, which has been achieved by backing 10 regional property companies. This creates a pan-UK platform of partnerships, allowing investors to access some of the best deal flow. On this call with me today, I have two of my colleagues. Alex Price, Chief Executive of Fiera Real Estate UK, and Rupert Sheldon, Fund Manager of the Fiera Real Estate Long Income Fund UK. After they have finished the presentation, they will try to answer as many of the questions that have been submitted in the time that we have available. So, without further ado, I shall hand over to them.
Hi everyone, this is Alex here. By way of brief introduction, before working in real estate, I served as an officer in the British Army and then worked in the investment banking division of Credit Lyonnais, a French bank. I joined what was then Palmer Capital 17 years ago, initially creating our real estate investment management business before becoming chief executive in 2008. That's me. Rupert, over to you.
Good afternoon, everybody. My name is Rupert Sheldon, and I head up the core real estate investment management team here at Fiera in the UK. Like Alex, I've been with Fiera for a number of years, a little over 14 to be precise. However, unlike Alex, I didn't start my career chasing tanks across Salisbury Plain, but instead learning the ropes in real estate, first in private practice, before moving to what was then Henderson Global Investors and now Fiera. I've been managing open-ended real estate funds for more than 15 years, and more specifically long income for the past 5. Now back to you, Alex, to kick things off.
Thanks, Rupes. A little bit about Fiera. We're a Toronto-listed asset management group focused on mid-market strategies across all the main asset classes. The firm is known increasingly for its focus on private alternative solutions, accounting for today around 10% of our assets under management. Within the private alternatives group, real estate is one of the key components, and that's split 2/3 in Canada and 1/3 in the UK. Fiera's focus on its clients first and foremost, providing them with actively managed strategies run by dedicated and thoughtful investment teams, all located in their own markets. And so let's talk about the markets to start with. The last decade has provided fantastic returns in pretty much every asset class. Real estate's been no exception, driven by quantitative easing, pushing yields down, and increasing demand globally from population requiring somewhere to live and somewhere to work. However, this year, it's all come to a grinding halt, with the UK commercial real estate valuations down around 2% in March for the quarter. But in reality, they're probably much lower, but they're masked by a limited amount of transactions that are happening. Last year, we had $17 trillion of negatively yielding fixed income, investors seemingly being forced from risk-free return to accepting return-free risk. This looks set, though, to get worse in the coming years, as over $5 trillion of liquidity and government support is injected globally to combat coronavirus. And if falling yields wasn't bad enough, there's an aging population as well that's increasing the pension fund liabilities. And in the UK, we're suffering this demographic shift as with everywhere else. It's no surprise then that these two factors are conspiring to increase defined benefit pension fund deficits. They're up nearly £10 billion in March alone, according to the Pension Protection Fund, and nearly £140 billion in total. Even normal run-of-the-mill investors are starting to get concerned. They're worried about where real returns can be achieved if this liquidity leads to inflation. Well, one answer might be to invest in real estate. Why? Well, in terms of absolute performance, UK property has provided outstanding returns in the last few years relative to the other major asset classes. The bar chart here showing you that. And this is a £600 billion commercial real estate market and a £7 trillion residential market. That's deep and liquid enough for every cycle. But it's not just return. It's the fact it does this with a low correlation to other asset types and a volatility that's pretty similar to fixed income. So you can see why I'm personally sold on real estate as a way to match liabilities today and in the years to come. The key, though, is to try to find assets within the real estate market that match the ever-lengthening liabilities. And that's where I'm hoping that Rupert can come in. Rupert, back to you.
Thanks, Alex. So before we go any further, let's define what we mean by long income. Well, in the UK, long income is considered to be anything over 15 years. With 94% of the UK commercial leases at less than 15 years, this is very much the exception rather than the norm. By point of reference, our Fiera Real Estate Long Income Fund, which goes by the catchy acronym FRELIF, currently has a minimum weighted average unexpired lease term of 16.2 years, placing it squarely in the long income space. This definition of long income needs to be set against the wider market trend, which has been moving to shorter leases over the past 30 years. As can be seen from the chart, in the past 18 years, the market has trended down from a little under 10 years to much closer to 5, and that ignores the many lease breaks that are commonplace within commercial leasing deals today. As we move through 2020 and the potential ravages of COVID-19, we expect that trend line to continue down below 6, a number only previously seen through the GFC years when occupiers saw maximum leasing flexibility for obvious reasons. So how in this backdrop of ever-shortening leases can landlords secure 15-year plus leases on a consistent basis? We'll look into how this can be achieved later on, together with the challenges around execution. However, for the most part, long lease strategies tend to achieve enhanced lease duration via an overweight to alternative sectors, such as hotels, hospitals, car parks, leisure, or even care homes. In short, operating assets, where tenants' businesses and their activities are bespoke to the building, and therefore a long lease offers operating business security and is seen by the occupier as an asset. This is supported by the MSCI Long Income Index, where constituent funds have an average exposure as at March 2020 to these types of operating assets of 47%. This compares to the wider market at a little over 10%. The flip side being a low exposure to traditional assets where lease duration is shorter. This brings about its own issues, which we'll consider later. So, why buy longer lease commercial real estate? Well, in recent years, the case has become compelling. Liability matching, where an average pension fund liability duration is give or take 20 years here in the UK, is the principal goal. And long income indexed real estate investing can offer a good match with its 15-year plus duration as a bond proxy. Over the life of a lease, investment value will normally trend down to a vacant value, broadly on a straight line basis. It therefore follows that a longer lease dilutes the annual impact of depreciation. Long duration, triple net leases, where maintenance and repair obligations rest with the tenant as opposed to the landlord, result in minimal capital investment from the landlord during the life of the lease. This is key. In a low interest rate, low growth market, a high degree of income security and minimal cost exposure helps optimize both income and total returns, resulting in outperformance. And that can be seen in the chart on the top right-hand side, particularly during times of volatility such as those seen here in the UK in the last 3 to 4 years. By way of comparison, and to evidence this point, the two charts at the bottom of the slide show the position at income rather than total return levels. And as you can see, there is an income advantage that can be enjoyed through averaging or smoothing long-dated indexed income streams with a low tenant counterparty risk or default rate and low vacancy rates with minimal dilution from capital expenditure. This leads to a higher blended income return over a longer period and a significantly higher Sharpe ratio, as you can see from the bottom right-hand chart. So on a risk-adjusted basis, long income comes out pretty well. But not everything can be quite as simple as that. So what are the challenges to execution? Well, the principal challenge has to be access to stock. As we've seen, only around about 5% of the market here in the UK offers up qualifying stock, i.e. 15 years plus, due to the changing occupier requirements for shorter leases and increased flexibility. This shrinking asset pool is dwarfed by increasing demand from liability matching investors, the point Alex has already picked up on. Stock levels are dominated by pre-let developments, sale and leasebacks, and operational assets. As we've already seen, those operational assets make up almost 50% of the long income universe, albeit there are inherent risks evidenced by poor rental collection statistics in March, where government-enforced lockdown effectively denied businesses the ability to trade. Ultimately, if you can't trade, you can't generate revenue. And as we're seeing now, if you're not generating revenue, you're unlikely to be paying your rent. Unlike offices, and we're all remotely working at the moment, as evidenced by your attendance via laptop at home today, or retail, where there's an online substitute. If you shut down a restaurant or a car park, for example, there's no substitute to physical trade. Worse still, there are long-term implications. How many people will flock back to cinemas having discovered the joys of Tiger King or Normal People on Netflix or catch-up TV? Our low relative exposure at Fiera Real Estate to operating assets at around 13% of the portfolio has helped drive high rent collection stats in March, and we expect to deliver resilience to our forward-looking income return. The key to deal flow is getting access to these specific areas of the market, particularly pre-let developments and sale and leasebacks. And this is where we at Fiera have an edge, working closely with our local development partner network, as explained by Minty earlier, where we have first call on all longer lease deals generated, giving us a real and tangible USP. Moving on, the next key area of risk or challenge is assessing and managing tenant counterparty risk. Whilst it's hard to underwrite corporate risk for 15 years plus, this is where robust systems and processes come in. For us, this means a three-tier approach to credit underwriting on acquisition, bar an independent third-party credit review, and both credit committee and investment committee approvals, with each committee having independent third-party experts. Ongoing monitoring and analysis of credit continues on a regular basis throughout the whole period. This rigor has helped ensure a consistently high occupancy rate and low default rate for the Fiera Fund, running at less than 0.45% or 0.1% per annum of total portfolio rent over the past 5 years. Whilst assessing and monitoring credit risk is front and centre of everything we do in the long income space, this is also supplemented by a focus within our investment strategy on high-grade modern buildings and also strong underlying residual site values, which help minimise depreciation and dilute tenant counterparty risk should this deteriorate over time. Finally, in the event of Armageddon, which for us would mean tenant failure, an ability to call on a trusted local asset management network across our 10 real estate businesses around the UK creates another built-in layer of protection. Finally, technological change. We're all very aware of that in our industries and in our marketplaces. Asset depreciation is accelerated by technological obsolescence, which can also compromise ESG credentials, an increasingly important area for everyone. Acquiring long-leased new developments enables an element of future-proofing at purchase on both of these key measures. Close to 50% of our long-lease portfolio comprises either sale and leasebacks or forward-funding new development schemes sourced and delivered by one of the 10 Fiera Real Estate-backed development companies. This enables an early engagement in key areas of design and specification and gives a head start in terms of future-proofing at both a technological and ESG level. I thought I would use an example to illustrate some of these processes that we work through in the long income space, just to highlight a real life situation. So this is an asset we acquired in Q1 this year. It's in Birmingham, the UK's second largest city, and the West Midlands conurbation, which has the largest population outside of central London. This is a logistics asset, so in the much sought after logistics sector. And as you can see there, a very visible, prominent site just along the A38, which connects the city centre to the M6 motorway network. Now, the key for us here is the quality and longevity of the income, which, as you can see, is 25 years to a good covenant, but also the progressive nature of the income. We have an indexation linkage to the 5-yearly rent review pattern within a range of 2 to 4%. But supporting that credit underwrite process, we've also got the important facet of strong residual site value. So because this is such a prominent urban logistics site and would be a great redevelopment potential going forwards, we estimated on acquisition around about 65% of investment value was underpinned by the land upon which the building sits. So a really solid underpin, irrespective of whatever building sits on the land itself. Also, over the duration of the lease, we have a minimum rental obligation from the tenant, which is almost 200% of the value of the investment at day one. So we have some really solid fundamentals here. Not surprisingly, this is leading to a pretty attractive average income return over the lease of 7.5% and a terminal IRR of just over 7%, which is effectively holding the asset down to a vacant possession value at the end. So these are really important parts of our underwrite, but hopefully in this example you can see how it plays out in practice. So, summary conclusions. We've seen that the long income investing space has outperformed through the cycle on a risk-adjusted basis, but what are the key takeaways? Well, rental indexation aligns the long income space very well, we believe, in a post-COVID, potentially inflationary world. As you can see in the chart on the right-hand side, 78% of our income exposure carries that indexation or fixed uplifts. A rigorous ongoing credit assessment process is key, and enhanced levels of tenant engagement will also help maintain a low default rate and strong rental collection, both of which are facets of what we do in the long income space, again, as you can see in the table to the right. Future-proofing by new developments will remain key, and that also serves to get over functional and technical obsolescence and help drive the ESG initiative. So all of those things together minimize obsolescence and protect future capital values. Residual values and local asset management are other key elements that we need to consider. Finally, the key will always be, in this space, access to market. There is always going to be a challenge in that area, so it's important that you're able to get access to market through the various channels I've explained. Hopefully that's a helpful canter through the long income space and what Fiera offers within that part of the market. Minty, back to you.
Thank you, Rupert and Alex. So for the next section of the webinar, we're going to have a Q&A. As a reminder, you can submit your questions at any time via the web console. Please do so via the question and answer tab, which is located at the bottom left of your screen. So on to the questions. The first one we have is for Rupert. How do you best access stock as the market looks constrained?
Thanks, Minty. So I think hopefully, as I've outlined in the presentation, it is a dwindling asset pool, and that isn't going to change. In fact, if anything, it's going to get smaller. So the key is being at the front end. You've got to be there at the delivery channel end. And if you can be there at the deal creation end, whether it's a development project, a pre-let development project, or indeed a sale and leaseback where you're using your corporate contacts to create deal opportunities, that's where most of the stock will come. I think I touched on, in the presentation on operational assets. Clearly, operational assets will carry meaningful value through the long lease structure, but one has to be very careful. And if the COVID experience teaches us anything, it's if you are going to buy operational assets, try and do so where you're not in a position where the business is completely disabled by a longer-term lockdown. But I think the key is going to be having that superior access to market. So it's down to relationships. It's down to corporate relationships with sale and leasebacks, or developer relationships for new pre-let developments. And hence our 10 Fiera-backed real estate developers giving us that sort of superior access to market.
Perfect. Thank you, Rupert. So the next one is for Alex. How has COVID affected your strategy for assessing tenant counterparty risk?
Thanks, Minty. Before I answer that, can I just offer a quick welcome, just looking at the attendees, welcome to clients of ours from the UAE, from Kuwait, from Canada, from the US, and of course from the UK. It's great to have you all on this call, and thank you for taking the time. In respect of how we look at counterparties, I think the process of how we underwrite won't change. For us, that's a three-stage process. That's whenever we look at an asset, an initial independent third-party credit review, followed by a second stage, an internal committee which has external credit professionals on it, and then the third stage, the real estate team looking at the assets. So that's not going to change. And I also think the monthly way we monitor, we do a monthly traffic light, as well as regular Dun & Bradstreet alerts. The kind of process bit isn't changing very much. And to an extent, the way we engage with tenants isn't really changing. We talk to ours, we meet them face-to-face at least once a year, and we talk to them at least once a quarter, regardless of how long their lease is. So that's not going to change and shouldn't change. But what I think we have realized is that early and better communication with your customers will identify problems, however strong you think that person is, and however long the lease may be. On top of that, I think you realize that cash generation is important, because if they're not generating cash flow in their business, then they won't be able to continue paying you that rent. And thirdly, as Rupert says, and actually this could be a complete revelation if I'm honest about it, is recognizing that if the property is the only access point for your customer to earn revenue, then you've doubled down on that risk. Because not only is your property not going to work for somebody else if the hotel industry is shut, but they're not going to pay you rent. So I think we've all learned that you need to underwrite your customers in a way that ensures they have the cash generation, that they have the relationship with you that allows them to be open and honest, and that they're not reliant on one source of access to market and to revenue. Minty.
Thank you, Alex. There's another one here for you, Rupert. What will be COVID's impact on capital values, and what is a realistic expectation for returns over the next 12 to 18 months?
Thanks, Minty. Well, capital values have been and will continue to be impacted by COVID, but disproportionately across the various subsectors of the market, we feel. Retail is and will continue to bear the brunt, with COVID accelerating the demise of an already troubled sector in that respect. But as always, there'll be winners and losers. So food retail, for example, and value retail, we expect to come out on the right side of the line and continue to buck the trend, where traditional high street retail is likely to bear the brunt of the current crisis. Our suspicion is that valuers will probably start to exercise a renewed caution across some of the operational assets where COVID has exposed this over-reliance on the asset itself for the business to function, and leading to an inability to generate any revenue. So restaurants, cinemas, or other assets like that may well carry some valuation scars when normality resumes, whatever the new normal looks like. Conversely, industrial, logistics, the more resilient sectors will probably come through in better shape. Overall, we probably sided with Capital Economics on this. They're forecasting something in the order of 10% coming off values through the remainder of this year. We think that's largely going to come off the riskier assets. By and large, long duration income, particularly 20-year plus, if anything, there's going to be a flight to quality. What the last few weeks and couple of months have shown us is the inherent risks of carrying higher risk real estate and indeed higher risk any asset class. So we suspect long duration real estate is going to be much more resilient with much less valuation movement.
Perfect. Thank you, Rupert. So there's another question. I think it's best for Alex. Could you confirm more about your background to your ESG policies in Fiera currently and going forward?
Yeah, I think ESG has been an important part of every business. And the way we look at it is we look at each component slightly differently. And forgive me because I'm going to park governance, the G, because to my mind, that should be a given. That should be an entry-level capability, and everybody should be addressing that. And I'm happy to talk about that separately. But if we look at the environmental side and the social side, I think what's happened during the course of this quarter hasn't fundamentally changed the way we look at the environment. Climate change is an issue, and we need to build buildings and own buildings that are more energy efficient and are better located, requiring less energy for people to get to those buildings. So for us, the environmental side of what we do hasn't really changed. I think the social side, though, has changed slightly in the course of the last few months. We've seen a huge wave of people and of interest in helping society get through the coronavirus. Now, I'm delighted to say at Fiera Real Estate, we have been able to donate Headley Court, which is the former Ministry of Defence Rehabilitation Centre. We bought that when it became vacant as the MOD moved. We've donated that and the use of that to the NHS for them to use during this coronavirus period. So that helps deliver capability, but it also means for the underlying pension funds, who are the supporters of our business in the main in the UK, that they can see that we are being socially responsible. And we need to be, because what we've seen in the last 12 years is a growth of inequality as asset-led inflation has increased those who have, whilst maybe leaving those who haven't behind. That will potentially get worse in the years ahead. So for us, the social impact of what we do, and I could list off other projects that we're doing in every community where our operating partners operate, because they're long-term community participants. I could list off more, but the S is really critical, and I think something we've focused much more on in 2020.
Okay, thank you, Alex. I think we have time for one more question. So probably back to you, Alex. Can you talk about your view on the office sector? Do you expect a reduction in demand given the possible long-term shift to working at home?
What we expect, and actually have expected for some time, is overall a reduction in like-for-like demand in the office sector. We think that because people are becoming more flexible and remotely enabled. And you can see that office utilization per employee has been growing for the last 10, 20 years. And indeed, buildings we're building today are space planned to be able to take 50% more people per area than they were 10 years ago. That's not to say that we're expecting more people to be crammed in the office. It's just we've put the capability of more loos, more lifts, more fire escapes to allow it to happen if that's what a customer wants. So I think we will continue to see buildings becoming more efficient in the way that they're run, and the sector continuing generally to not grow like for like as the population and the working population grows. So we won't necessarily see a reduction in stock, but it won't grow as fast as the workforce grows. What we are going to see, though, is more and more people wanting better and better quality offices. Not just our customers who are paying the rent, who want to have offices that are capable of taking all their workforce if they all chose to go to work on the same day, but also people who don't have to go to the office. So they need to be incentivized to go to the office by being at a place where they want to be, not by being at a place where they feel they have to be. So we think that those central, amenitized, well-connected, well-serviced offices will continue to be the place where people want to live, where they want to work, and they'll be close probably to where they live. We think urbanization will continue as a theme, and I do realize that business parks have a place, but actually getting everybody off the slip road from the motorway into the business park makes it pretty difficult to have everybody working there on a surge day, whereas public transport does allow that. And post-coronavirus, I think we will continue to use public transport as the only environmentally sustainable way of getting to and from work. So in short, offices as a sector will continue to grow, but not as fast as the workforce. And the drive will be for good, modern, high-quality, amenitized buildings.
Thank you, Alex. That's just about all we have time for today. So just like to thank you once again, Alex and Rupert, and thank you all very much for attending. For any further questions, please do not hesitate to contact Rupert or Alex, whose details were shared at the beginning of the presentation. As a reminder, today's webinar was recorded. A replay will be available 24 hours after the call using the same link you used for this call. Goodbye and have a good rest of your day.